Hi everyone, I'm Basil Nilambra, tutor for financial reporting at Kaplan School of Accountancy and Management, a platinum approved learning partner. In this video, I'm going to debrief FR pre-December 2024 mock exam, section B, Osborn Company question 16 to 20. If you have already done this question, you know that the question is related to IAS 16 property, plant and equipment and IAS 40 investment property. Property 1 cost 900,000. Please read the question. Osborn Company purchased two properties on 1st July 20x7. Property 1 cost 900,000 and was used by Osborn as a head office. Legal costs relating to purchase were 30,000. During the course of year ended 31st December X7, Osborn Company had to repair a part of roof at a cost of 2,000. So there is a legal cost associated with the $30,000 and a repair cost of $2,000. Property 2 cost $300,000 and was immediately rented to corporate tenants for $1,000 per month. So it is rented to corporate tenants. So property 2 is investment property since it is rental, and the rental income is 1,000 per month. On 1st September 20x8, Osborn converted this property to sales office for its own use. So there was a change in use from investment property to property, plant and equipment. The fair value of building was as follows. Property 1, 31st December X7, 925,000. September X8, no information given. 31st December X8, 895,000. Property 2, 31st December X7, 320,000. 1st September X8, that is date of change in use, 337,000. And 31st December X8, 340,000. Extract from Osborn's accounting policies note are provided below. Osborn measured owner-occupied property using revaluation model and depreciate it over a 20-year useful life. Osborn measures investment property using fair value model. So once it is fair value model, the investment property will not be depreciated. Now, please read the question number 16. According to relevant IFRS accounting standard, how legal costs relating to purchase of property and repair costs is recognized. You know that legal costs associated with purchase will be capitalized as a part of asset in its initial recognition cost, and repair costs will be expensed off to P&L. So option A, legal costs should be included as part of initial measurement of building, and roof repair costs should be recognized as expense in profit and loss account. Straightforward, option A is the answer. But let's read option B, C, and D as well. Legal costs should be included as part of initial measurement of building. That is correct. And roof repair costs should be added to carrying amount of building. That is wrong. Roof repair costs cannot be added to carrying amount. Roof repair costs cannot be capitalized. Roof repair cost is expensed off in profit and loss account. So option B is wrong. Option C says that legal costs and repair costs both should be recognized as an expense in profit and loss account. That is wrong. Legal costs associated with purchase of an asset should be capitalized along with initial recognition cost. Repair costs can be expensed to P&L. So option C is wrong. Option D says that legal costs should be recognized as an expense. Again, wrong. Legal costs associated with purchase of an asset should be capitalized as part of initial recognition cost. Repair costs should be added to carrying amount of building. That is again wrong. Repair costs added to carrying amount means they are saying repair costs should be capitalized. That is wrong. Repair costs should be expensed off in profit and loss account. So the correct answer is option A. Legal costs related to purchase of an asset should be included as a part of initial measurement, and roof repair costs should be expensed off in profit and loss account. Moving on to question number 17. What is the total amount that should be recognized in statement of profit and loss account for the year ended 31st December X7 in respect of property 2? So remember, total asset means basically there is minimum 2 items, because only 2 items can be total or more than 2 items. So you have to identify at least 2 items in this case to be recognized in P&L. And the year end is very important, 31st December X7 in relation to the property 2. So year end is 31st December X7 means year begins from 1st January X7 and ends on 31st December X7. So what happened to property 2 in the given period January X7 to 31st December X7? So if you read the question, you can see that on July X7, that is in this current year, a property 2 was purchased. So Osborn Company purchased 2 properties on 1st July X7. So property 2 was purchased on current year 1st July X7. 1st July X7 cost is $300,000. And if you remember, the question says that Osborn measures investment property using fair value model. So if they're using fair value model, means that the investment property at year end should be recorded fair value. So on 31st December X7, the investment property should be measured at its fair value. And what is the fair value on 31st December X7 property to 320,000? So cost is 300,000. Since it is fair value model, no depreciation. So it has increased from 300,000 to 320,000. And we have learned that any increase in fair value should be recognized in P&L as income. So the 300 to 320,000, the gain on investment property, 20,000 will be recognized in profit and loss account. But we need 2 items minimum. It is total. So what else will be shown in profit and loss account? The question very clearly says that this property is rented. The property was bought on July X7 and it was rented for $1,000 per month. So rental income from 1st July X7 to 31st December X7. How many months are there? July, August, September, October, November, December, 6 months. So $1,000 multiplied by 6 months, that is equal to $6,000. And this will also be shown in P&L. So total to be shown in P&L is fair value gain of investment property 20,000 and rental income for 6 months 6,000. So total 26,000. So an income of 26,000 will be recorded in profit and loss account 31st December X7 in relation to property 2. Moving to the question number 18. According to relevant IFRS accounting standard, what are the accounting steps that should be taken to correctly recognize the account conversion property 2 into sales office on September X8? So the question has stated that on 1st September X8, Osborn converted its investment property to sales office, property, plant and equipment. Change in use. So what should be done? They have given some tokens. Transfer the property between non-current asset classification in statement of financial position. Measure the property at its fair value of 337,000. Depreciate the property. Step 1, step 2, step 3. We have learned that when there is change in use, the new asset will be recognized at its fair value. So step number 1 will be measure property at its fair value of 337,000. And the old asset will have to be recorded as new asset, or investment property will have to be recorded as property, plant and equipment. Journal entry will be debit property, plant and equipment, and credit investment property. So step number 2 will be transfer the property between non-current asset classification in SOFP. The investment property will have to be reclassified into property, plant and equipment. So that is step number 2, transfer the property between non-current asset classification in SOFP. And third one, it's now property, plant and equipment, so it should be depreciated, will be the third step. Moving on to question number 19. Which statement best describes accounting treatment that should be applied to the decrease in fair value of property 1 in the year ended 31st December X8. The decrease is recognized in profit or loss. The decrease is recognized in other comprehensive income. The decrease is recognized in other comprehensive income to the extent that revaluation surplus exists for property 1 and thereafter in profit and loss. And the decrease is recognized in profit or loss to the extent of any previous increase in fair value and thereafter in other comprehensive income. So here you can see that the cost of asset is 900,000 on July X7 and 30,000 will be added. So 930,000. It will be depreciated. So value will be lower than that. And at 31st December X7, the asset is, they are following fair value model. The question very clearly says that Osborn measures owner-occupied property using revaluation model. So in 31st December X7, definitely the fair value of asset has increased. So there will be a revaluation surplus. Now they're saying that in next year and at 31st December X8, what if there is a decrease in fair value? That means a downward revaluation. So the asset on 31st December X7 in previous year was revalued upwards earlier, is now getting revalued downwards. We have learned that in this case where there is opposite happening, first we have to cancel the revaluation surplus in OCI and balance will be shown in profit and loss account. So option C is the correct one. The decrease is recognized in other comprehensive income, that is revaluation surplus, then in P&L, option C. The last question, which of the following properties, which are also held by Osborn Company, should not be recognized as investment property? So they're asking which of the following is not an investment property. Red House, which is an apartment block occupied by Osborn employees, all of them pay market rent. That's the answer. The apartment rented by employees is treated as IAS 16 PPE. Not all rented property is treated as investment property. If the property is given on rent to the employees of the organization, then it will be treated as owner-occupied property under purpose of administration purpose, and it will be treated as IAS 16 PPE. So we got the answer. Option A is the answer. But let's confirm. Blue Tower, which Osborn rent from an unrelated party. So they are renting it. So it's not an investment. It's an investment property. Green Place, which is land for undetermined future use. We have learned that in IAS 40, investment property, a land held for undetermined future use will be treated as investment property. So that's not the answer. Black Center is a shopping center let to retailers. Osborn provides maintenance and security service to tenants. They are letting this shopping center to retailers. So again, it's an investment property. So the option A, renting to own employees, we have learned as per IAS 40, it is outside the scope of investment property. It's property, plant and equipment. So option A is the answer. So I hope you have understood this question 16 to 20. If you find this useful, give your likes and don't forget to subscribe this channel as I'll be coming with 21 to 25 section B question quite soon. All the best for your December 2024 examination. Goodbye.